US Treasury is a sovereign debt bubble waiting to burst. But when, dude? When? The deficit itself is 2 trillion, but the problem is 5 and the 7. So it's 7 trillion out and 5 trillion in. Why is $2 trillion in deficit year after year after year, resulting in solid GDP growth, solid wage growth, solid margin growth, all-time highs in stocks, and treasury yields like still almost where they basically were 4 years ago? I look at Bitcoin treasuries as simply a levered Bitcoin play. If it doesn't outperform, then your liability structure is going to eat you up.
Hey everybody, welcome back to the BitcoinTreasuries.net podcast. Tyler here, and my guest today is Nik Bhatia. He's the author of Layered Money, founder of the Bitcoin Layer, and one of the sharpest voices connecting the treasury market to Bitcoin. Nik, welcome to the show.
Tyler, thank you for having me.
You got it, Nik. So this is a real treat to talk to you today. Love your macro analysis, but let's talk Bitcoin and what's your take from the last year? You know, Bitcoin hit an all-time high last October, and stocks have mostly climbed since then. With a few drawdowns here and there, but Bitcoin hasn't. It's gone down. It's chopped around. What's that divergence telling you, Nik?
It's telling me that Bitcoin and stocks are experiencing different sensitivities to the macro environment. They still are correlated, and I think that's something that generally even I have a tough time explaining to people. How are two things correlated, yet one is up a lot and one is down a lot? And it's tough to imagine how that's possible, but what you have to imagine is that correlation is essentially covariance. And so what we're doing is we're measuring, for example, daily variance. Up, up, down, down, up, down. That's what you're measuring. So on a day where both things go up, that's going to be correlation, and both things go down. But the magnitude of the moves can vary greatly and end up in this huge divergence of returns. And so that's statistically what's happening. I think that's important to note. The reason I think it's important to note is because the fact that Bitcoin and stocks are correlated still, even though the returns are divergent, means that they're both sensitive to liquidity. And the reason that, first of all, at the Bitcoin layer, we have TBL liquidity. It's our index that we use, and we're using it to measure all sorts of movements in markets, across markets. But the reason that we really tried to laser in on an indicator and a metric and an index itself was that we felt that we could measure the impulse in markets. Like, is it good or is it bad? And if it's good, that should mean things go up, and if it's bad, it should mean things go down. So we did research and development over this for a long time. We came up with this formula. We've only adjusted it once in the early days, so it's essentially unadjusted for the last, I would say, about 1 year now. And what we discovered is that when rates are up and the dollar is up and volatility is up, it's very difficult for Bitcoin to go up. Extremely difficult. The stock market, though, has done very well over the last few years because there is an AI revolution going on. There is a CapEx boom. There is a productivity boom. There's very strong nominal GDP growth, which is inflation plus real growth. So there's real growth in the economy. There's also inflation, which boosts prices. That boosts revenues, and it can boost margins. It can negatively affect them, but if you're the ones who gets to raise prices, then you're the one that's benefiting from all the inflation. So in essence, Bitcoin has run into a strong dollar since November. And I can pull it up on my side so I can just give you more of an exact. I have this touchdown of this trend line in June of 2025. So you could even argue that we're 1 year into this. But then in in September of 2025 and have double bottomed in the dollar. And we did have a touchdown in January when there was like a lot of risk off in the market, but essentially since June and September of 2025, we've been in a strong dollar regime. And that strong dollar regime, it has filtered through to our liquidity index, which topped on February 3rd of this year. So you would have missed, if you're measuring just on that peak basis, we were late to the beginning of Bitcoin's bear, but actually on a shorter term basis, we were able to identify mid-January when Bitcoin was still in the 90s and saying, hey, it's turning over. But essentially, Bitcoin has been up against a strong dollar for a year. And that has proven to be an insurmountable challenge. On the other side, Tyler, I would say that Bitcoin reached a very, relatively speaking, expensive valuation around the middle of last year, and that brought all the OG selling, and that selling pressure, and essentially just the simple realization of profits from long-term holders. That's a 1-2 combination that Bitcoin has not been able, or was not able to shake. The stock market didn't have the OG seller component to it, and it also is actually the recipient in many ways of the flow that moved the dollar higher. What I mean by that is that if you are a global investor and you want to buy Nvidia, you want to buy US corporate bonds, you want to get into SpaceX's IPO, you want to be positioned to buy American equities that are doing well, you have to sell your local and buy dollars. So it's actually part of the strong dollar trade, I believe, was a strong US economy trade and a capex trade. Again, everything is hindsight, is 2020 in hindsight. So a little bit of Monday morning quarterback, but that's part of the job too. You have to look back and try to assess what has happened. And I hope that gives you a summary of why these two assets haven't traded similarly for quite a while.
Yeah, that's really good perspective, Nick. I've got a couple questions to tag along from that answer that you gave. I guess zooming out, people have a lot of opinions about Bitcoin. People are in it for very different reasons. There's the ideological component. Some people view it as, a leading indicator, or a prime asset as part of the debasement trade, as part of a broader portfolio. I guess a couple questions is, do you think Bitcoin moving forward will kind of stick in that risk on bucket? Obviously you're monitoring liquidity and tracking the strength of the dollar and the injection of cash into the system, and that's obviously extremely correlated with Bitcoin's price. How do you view that in the larger picture? How does Bitcoin trade in the future? How does it break out from its risk on kind of characteristics? Can it trade like gold someday, as the market cap grows, as a lot of Bitcoiners think it will, to flip gold? Maybe that's decades away, certainly. And then I guess another question, maybe you can touch on this, or we can come back to it. Do you think that OG seller phenomenon is something that's going away and is going to be tempered as Bitcoin kind of grows up here?
Okay, let's start with the OG. The OG selling comes from where you don't know what cohort it's going to come from. What you can see is when it's happening and when it's petering out. So essentially, what we have right now is OG selling was last year's business, and you're not seeing it to that same extent or anything of the sort right now. But when Bitcoin goes up again, one day you'll have more OG selling. So it's not a permanent thing, but right now, yes, it's declining.
I
From
guess
that,
my question on that, Nick, is it more unique to Bitcoin that we see that separate from equities?
is it more unique to Bitcoin that we see these
When
waves of OG selling? It is unique to Bitcoin, and eventually, yes, the the materiality of OG selling will decline, and that's just common sense, right? Because as people sell eventually, then then the number of people that can sell that quantity to materially hit the market declines because nobody has that. The age of the coins goes down, of course, and then the cost basis goes up. So nobody has that, or the quantity isn't there to be actually have the same market effect that you had in 2025. Now, the reason you didn't see the price go down that much in the beginning was because institutions were buying. So the OGs were actually dumping on the institutions in 2025, and that's what we see there.
Yeah, and then on the broader kind of like, Bitcoin's breakout or
Yeah.
maturation away from, maybe a risk on bucket.
Yeah, that's a good question because it can be measured in by behavior but also by correlation. So on the correlation side, let me answer that. Do I think Bitcoin and the stock market are going to uncorrelate over the coming years? Not really. That's not that's not my base case assumption. I do believe they're both liquidity sensitive, and so it means they are the assets that are demanded at the margin. So when there's excess liquidity or supportive conditions, what gets bought up? Stocks and Bitcoin. They'll both be in that camp. They're in that camp today, and I believe they'll continue to dance around together there. Now, what other asset classes might Bitcoin seek correlation with in the future? Could it be gold? Could it be US Treasuries? Could it be inverse stocks? Inverse US Treasury, which in some ways it's inverse Treasuries. In some ways, more and more, it's becoming an inverse DXY trade. Not purely, but maybe on a short term. That's why DXY is part of our liquidity index. When it goes up, liquidity goes down. And that's what we've seen, since February 3rd. It's a strong dollar in large part. And of course, treasury yields and the dollar have a relationship. It's dangerous to get causal there by saying that higher yields are the driver of a stronger dollar. But at the margin, interest rate parity does suggest that higher rates will attract strength to a currency. You see all that going on there. So in what ways does Bitcoin stop being a negative DXY trade, a positive stocks trade? Well, it could increase in its correlation to gold. And gold and stocks, the correlation isn't very strong. So that means that the gold and Bitcoin correlation also isn't very strong. But I think that could go up as Bitcoin takes on more and more of that neutral role. And could it jump to a positive treasury correlation, meaning that like if treasury yields were to go lower, that's a flight to safety, right? That type of trade right now benefits Bitcoin because when rates come down, discount rates come down, present value calculations go up across equity space. Bitcoin benefits from that kind of whole rate sensitivity environment on the liquidity side. Also, collateral values go up throughout the system. So credit availability goes up and Bitcoin responds. What if there's a break in that? What if Bitcoin becomes an alternate to treasuries so that when Bitcoin goes up, it's because people are selling treasuries to buy it? Well, that would be a crazy change if we were to see that happen next year, right? You would agree with that, right? But is it crazy to think that can happen 5 to 10 years? No, it's not crazy, but I wanted to give you those sort of extremes in terms of my expectation. My expectation is not much of a change. I think Bitcoin is a liquidity sensitive asset, and it continues to be. Could it creep up in terms of its relationship with gold? Yes. Is it really going to change its relationship with DXY, where strong dollar is a tight financial condition on the world and therefore punishing to Bitcoin? No, I think that continues. And that means a weak dollar is good for Bitcoin.
Yeah, makes a lot of sense, Nick. As we think about, I guess the liquidity environment, um, Kevin Warsh stepping in as the new Fed chair has been, the most talked about development, I would say, this year. Of course, you have the geopolitics of the Iran situation that are affecting rates and uncertainty in the marketplace. But what's your read, I guess, so far on Kevin Warsh's chairship? Of course, there's been some, I guess, atypical dissent on the votes on whether to keep rates the same or hike. Where just recently, as of this recording, we had three of the board members vote to increase rates. Warsh has said a lot of hawkish things in recent years before he was elected chair of the Federal Reserve. But what's your take of how his kind of chairmanship plays out? And do you think he can? How is he going to land this thing?
Warsh has been very interesting to watch, and I feel like I got to know what he's up to for the first time yesterday. And because I think the first, pre-Fed, it's hard to judge what he's going to be when he's in the seat. And then his first day on the job, he was, just trying to pre-announce some of the things that he was going to work on. But then rates went up, and bear flattened dramatically between his two meetings, and then he had to come and explain it to people. And I learned so much about Warsh and what we might expect. And it also, you have to admit when it is, but I'm also using it as confirmation bias, thinking that Warsh might be here to turn over a new leaf or do something different at the Fed. And so that's the vibe I'm getting from him, that he's here to change how the Fed works and what it's there for. The fact that he defended the emergency actions and forward guidance post 2008 crisis was interesting to me. He's not saying that the Fed was always broken because it's trying to maneuver rates and guide the market and give forward guidance. He didn't really say that. He said we were in a crisis, so it was right to say, hey guys, we got everything. Looking forward a couple years, we won't be raising rates that much, and you guys can make investment decisions. So that was interesting to me that he supported that approach, but he also said we're not in crisis anymore, so we cannot be in charge. The markets have to be in charge. And what it means is that the days of Fed watching for now are either over or just materially different, meaning a lot of Fed watching has been watching the economy, watching rates, and then watching the Fed's reaction to that and what they say. But now it's just you don't worry about what the Fed is going to say. You actually, he wants you to not worry about what the Fed is going to say. And he said that he wanted it, but I don't know if everyone believed him. I'm not sure if I did, but yes, as of yesterday, I definitely believe him now. He doesn't want you to know what they're going to do at all. That is fascinating to me. And maybe I'll just pause there as my first impression, because I can't remember the rest of your Warsh question, but I wanted to give you that feeling that I got yesterday, which is that as a financial professional, I've had about a dozen years of official Fed watching. You watch rates, you watch eco, meaning the economic statistics and the way that they're coming out. And I'll come back to that in a second. But you watch all these things, and then you read the Fed speeches. You read the speeches. You read the the line, you listen to the press conference and you try to, and I was very good at that. I could read the statement, I could listen to the speech, and I could tell you exactly what the Fed's going to do for the next 6 months without a question, and almost never, never wrong. And by the way, they wanted the market to be able to do that. That's why they did it, so that there were people like, people like me and others in the financial industry that would tell you, okay, this is what the Fed's going to do. They told us, you guys make your decisions accordingly. But not only that, is he not going to tell you, he also said, we're probably going to change the data we use to make our decisions, and we don't know yet. We started a task force. I mean, talk about the days of Fed watching being over or completely reversed. Now we don't even know what data they're going to use.
It's official. The Bitcoin Treasuries conference lineup just dropped. Grant Cardone, Adam Back, Eric Weiss, the man who introduced Saylor to Bitcoin in the first place. Plus, the CEOs actually running the treasury companies and the macro voices calling out where the institutional capital goes next. 10 confirmed speakers, 1 closed-door room, September 28th in New York at 2nd. Save 10% on tickets today by using the code SECOND. Reserve your seat by scanning the QR code on the screen or visit bitcointreasuries.net/conference. We'll see you in New York.
So it's brilliant. I love this. And I'm all for the change. And the last thing I'll say is he actually credible that he can get inflation back down to 2%? Not at all. There's nothing that says that that's what he can achieve. So let's not give him any credit for that in advance, because that's not what I'm saying at all. But I'm very supportive of this idea of just let the markets talk. He talked about the Treasury yield curve all afternoon yesterday. It was great.
Yeah, no, I love it. You love to see it. Definitely from like a free market perspective, just letting the markets cook, I think is the right posture for the Fed to take, because they really tried to influence rates, like you said, as someone who watches it intently. Like there was a lot of signaling with every meeting. You had to kind of hang on every word and navigate what the Fed was going to do for the next several months. Do you think this means there could be more volatility in rates and in the marketplace, and maybe in treasuries specifically? And how does this new posture from the Warsh Fed affect the broader market?
It is by definition the release of volatility. And by release, I mean the vol sellers cannot get involved to the same extent anymore, because the range of outcomes is wider. And when the range of outcomes is wider, you cannot sell insurance at the previous tight range that you were selling it at, because you had a higher degree of confidence of where it would stop on the downside and where it would stop on the upside, because someone would come in and make a speech. And if you do not have that expectation, you can't sell vol there, so you have to widen it or step away until you figure out what's going on. So by definition, it's a release of volatility, because the vol sellers are motivated by the forward guidance, or they have an excuse for selling that insurance into the market, because they've been told by the Fed it will be here and it will be there, and this is where we think things are going to go. So what's ironic about all this, Tyler, is that I've always said the Fed is just trailing the market, and it's just like trailing treasury yields anyway, and so it's going to have to do what it says. So this is somewhat of a realization of the fact that that's already the truth, but I still think that you have to think philosophically about what this does to vol sellers. Whether it actually increases volatility is a straight financial projection that it's difficult to make. I would answer, my bias would be yes, judging by what he said yesterday and what happened between the June and July meeting in the Treasury market, which is that yields went up quite a bit, and volatility went up, but not it actually didn't go up that much. It came down after Warsh.
Looking at Bitcoin's chart over the past year, we've seen some clean structural trends. Most of you hodl long term like I do, but to trade short term moves, the easiest way is with Kalshi perps. Sometimes I'm sure that next leg in Bitcoin's price is just around the corner, and perps allow me to position for that exact scenario. Kalshi has a CFTC regulated US exchange that are bringing perpetual futures to American traders for the first time. Perps let you trade Bitcoin's price movements up or down with no fixed expiration dates, unlike typical futures contracts. So I could take my leverage up to 6x without even holding spot, and that can amplify both my potential gains and potential losses. Leverage trading obviously isn't for everybody, so carefully consider your own financial circumstances. Scan my QR code on screen or sign up at kalshi.com/p/Bitcoin Treasuries. And as always, make sure you trade responsibly and don't forget to stay orange.
Per the move index, which is implied volatility on treasury options. So it's a market metric. And so I'm a big believer in you buy the rumor, sell the facts. So you buy this rumor that it's going to be more volatile. And then he says, yeah, by the way, it's going to be more volatile because I'm not going to tell you anything. And it's actually has the reverse effect. And now people say, okay, actually, now I think the market will be calm because I trust in the decision makers. It's this whole psychological game. So I wanted to answer it a few different ways, if that's okay.
Yeah, no, that's really great. Thinking about the broader implications of that, you touched on, getting back to 2% inflation isn't a realistic short-term goal. Maybe we can tie that back to Bitcoin. What's that mean for Bitcoin over, the medium term here? If inflation does stay elevated, we've seen 30-year or 20-year highs in the 30-year Treasury, steepening of the yield curve. What does that mean for, I guess, the broader equity market, Bitcoin, and liquidity in general moving forward over the next, say, 3-4 years?
This might be oversimplification, but I think almost nothing. Where would it be dangerous is if inflation materially accelerates and we ratchet up to a 5-6 handle, and that's where we are. This 3 to 4 handle that we've been in is now a 3-year reality. We had this huge spike and it came back and it's structurally higher than before, but that structurally higher than before is digested. Stock market has performed very well. Treasury market yields have gone up, and I'm more bearish structurally on the treasury asset class, especially the long end of the yield curve, because structural inflation really, I do believe, is here to stay. But if it's 3.5%, market, actually everyone can do it. Because if wages are, let's say inflation's at 3.5, let's say wages are at 3.5 to 4. Check. Let's say profit margins remain solid or the same. Check. And savings rate, it's gone down to 3%, but it doesn't fall any further. Let's say it doesn't. Another check. And stocks, by the way, have doubled like over this time where we have structurally higher inflation in the 3 to 4%. So stocks are fine. The political class, is there like revolution on the street? No, we're going to go back, and the House goes back and forth between the left and the right. Senate leans right. Presidency has gone back and forth. And it looks like we'll have another split Congress after November. So is it material on that side? No. We've also had a war, and now you're going to basically lock in the next several trillion of defense spending in a time where maybe, were we dialing back the defense spending relative to the total budget now? And what has it done to, it's not that what has it done to treasury yields, but what has it done to the economy and the stock market, which is it hasn't done anything materially bad. The stock market is good. The economy is good. The employment rate is fine. Wage growth, real wage growth is the biggest challenge Tyler. If we really want to talk about it, real wage growth is the absolute biggest challenge, and it's the biggest problem for the political class too, because that is what people care about. They care about their wage versus their costs. And if that's negative, that is bad. And so that is what we have to avoid. But
I want to talk about something that comes up in almost every conversation I have with Treasury executives. They get the Bitcoin thesis, they see the macro case, but then they walk into a board meeting and the first question is, who's holding it? Are they regulated? Are they insured? Can we audit this? That's where BitGo comes in. BitGo is an OCC regulated national trust bank. That means they operate under the same federal oversight as the institutions your board already trusts. Your assets are held in segregated trust accounts, never commingled. They're secured in 100% cold storage with multi-signature architecture. If you're building a case for Bitcoin on your balance sheet, BitGo is the custody partner that turns a board conversation from why into when. Visit bitgo.com/Bitcoin-Treasury to connect with their team.
You wished for it. Bitcoin is finally on sale. And if you're sitting on BTC and want liquidity without dumping your stack, Arch Lending can make it easy. You can get USD or USDC in minutes, and your collateral stays in qualified custody. They never rehypothecate your assets. As your assets move up and down in value, you can scale your credit line instantly or pull collateral back when the market runs. If you need help, you get real humans 24/7, not bots. This is Arch Lending. Simple tiers, public pricing. You can check them out at archlending.com.
by itself, 3.5 inflation, and the Fed just completely fails to get it back to forget they can't even get it to like 2 3/4 and all that. I don't think it matters at all. And I want I don't want to overly simplify 3.5% inflation, but if I were to answer your question, it's at 4.5 to 5. Where, okay, now let's ask that as a different question. Okay, what if it gets to 4 and 5? What do you think there? Then I can give you a separate answer. Maybe we could do that next. But here, I don't think it matters really at all.
Sure. Yeah. It's, the market's so quick to adapt to new normals. And it still is a little bit startling to see, this elevated inflation. I came of age like in my working life, post GFC, and we were in these, zero rate interest environment, for basically my whole adulthood. So it's kind of wild to see how like the market has just been able to absorb this. And I think you're right. Structurally, we're in this kind of new normal. Thinking about a new normal, what's your perspective on government funding and the Treasury raising money in this new environment? If the long end is really expensive to finance, famously Janet Yellen at the Treasury during the Biden years did a lot of short-term financing, and Bessent under this new administration said he wanted to unwind of that, was really critical of it from my vantage point. But he's had a hard time unwinding that. So, is that the new normal for I guess, Treasury funding by and large is to, hey, we're all just going to finance on the short end?
It is. And it is not. What's interesting to me is that it's not punitive in almost any way. So it benefits liquidity because the banking system gets more safe assets, and they can essentially leverage them, 50 to 1. So it's and then that money that the banks create gets back into the economy. It also prevents the long end from being issued, which suppresses yields. So it's a manipulation of the yield curve in some ways. And that is the danger, that then you have to roll it out. But at the margin, there's a lot of room for them to do it in bills still. Because there's just, and by the way, you want to tie in the Genius Act. This is why they want stable coins. They need that buffer to keep issuing bills out into the market and not really hit the bill market. And the way that we measure that the bill market and the risk in the bill market it's really a function of supply. When there's too many bills, the spread blows out, is that you look at it versus overnight index swap. So you basically look at it versus the Fed funds rate and the curve of the Fed funds rate. And you can see with a bills to OIS curve what the risk is in bills, meaning that there are too many bills in the market. And that spread will chop around. But what it's basically telling you is that there's plenty of room for the Treasury to do anything they want there. The problem, Tyler, is that, as you know, the deficit is so large on a nominal and a percentage of GDP basis. It's also very large in terms of the deficit itself is, let's call it 2 trillion, but the problem is the 5 and the 7. So it's 7 trillion out and 5 trillion in. And when you break down that, and these are approximations over the last couple of years, but if you just say it's 7 out, 5 in, and that's a deficit of 2, which is about what it is. When you break down the 5, getting it to 7 is it's an insane hurdle. You'd have to raise taxes, or the nominal GDP has to grow. So what they're betting on is that nominal GDP is going to grow, and it is growing at a nice clip. 8% is really good. If they can have it at 8, even 10% nominal GDP, that would be amazing. That would be good for the revenue side. But you can't ratchet it up, because it's going to be very bad for the economy to increase taxes. I mean, that's like that marginal effect that you say it's quick to adapt, but that pain of higher taxes, the government, neither party, well, obviously the right doesn't want to do it, but parts of the left want to do it. But if they do it, they will lose the next election right away anyway. So this is known. Then the 7, the problem with the 7 is that there's zero room for it to go down. And that one of the 7 is interest, and that looks like it's heading to 2, like almost with certainty, because the entire curve is rolling from the 3 handle to the 4 handle, and that 1% of 40 trillion is basically almost half a trillion by itself. So now, it's really getting away. And then, I mentioned the military side, it's close to 1, but what if it goes to 1.5? That's another, that's another half a trillion there. And you're just throwing these numbers around. And, I'm not sure what, or let's just say this on the Social Security and the Medicare side, because I said something last week that people misinterpreted. Social Security and Medicare are transfer payments that are a fixture of our society. You have to understand, neither party is mentioning anything about removing these benefits and these transfer payments. It's a social safety net. They're transfer payments, but neither one of those phrases is a critique. This is the way that our country operates. We have these 2 social safety nets, Social Security and Medicare, and they are a fixture there. And it's not a new fixture, right? This has been around for more than a half century. So this is part of the fabric of the society too. So the point is that that's not going anywhere. Then what does the federal government actually spend money on outside of interest, Medicare, Social Security, and the military? It's almost nothing. The people, like with the Doge stuff, you're not talking about the actual expense. So the government has a lot of work to do on Medicare efficiency. I will suggest that. I'm not advocating for /care. I'm advocating for actually more of a private market approach to it. Possibly there are a lot of good ideas that we don't have to go down a Medicare rabbit hole here. The point is that the 7 goes to 10 quickly, and you see a path for it to get there quite easily. The 5 going to 10 looks to be nearly impossible at any, similar pace. And so you have this structural deficit that one day will have to be reconciled. The danger is that the political class in the United States has never really had to face that. And what I would suggest also is that if the United States political class is forced to face it, which it might be in the process of doing right now, as maybe certain parties will say, well, the cost of living, it is because we have this deficit and the amount of debt, and it's all contributing to inflation. If that becomes part of the political dialogue, then you get politics that might try to close the deficit. But I've never seen it. And for me to forecast that, it would feel aggressive, even though I know that it's very popular for people in my industry, let's say financial commentators, to say that the US Treasury is a sovereign debt bubble waiting to burst. But when, dude? When?
This episode is brought to you by Kalshi. And here's what keeps bringing me back to Kalshi Perps. I don't sell my Bitcoin, ever. But there are weeks where I've got a strong short-term view and no clean way to act on it. That's the gap perps fill. Kalshi is a CFTC-regulated U.S. exchange, and it's the first time Americans can access perps onshore. You take a position on whether the price goes up or down with no fixed expirations. You close when you want, and I can go up to a 6x multiplier, which amplifies both my gains and my losses. So I size small, I set my stop before I open anything. Leverage trading isn't for everyone, so carefully consider your own financial circumstances. Scan my QR code on screen or sign up at kalshi.com/p/Bitcoin Treasuries. Trade responsibly and stay orange. Yeah. Oh man. Yeah. It seems like we're so far from that entering mainstream political discourse, but you never know. There've been a lot of surprises throughout history. So, but I do think you're right that that's kind of really the only way the current trajectory can kind of unwind.
And Tyler, I really think it's important, and I do this myself. I go back and I read, what did I write in 2021, 2022? What was I saying? The Bitcoin price stuff is going to be all over the place for sure. The rate stuff is different. Like I said, it's my core competency, and it's something that I think is really important. Go read and watch my stuff from 4 years ago and other people. I think it's important. The people that are saying, like, we're in a sovereign debt bubble and, the deficit is unsustainable and it's going to lead to 8% inflation and, the bond markets are going to collapse and Bitcoin is going to go to the moon. And, you have to hold yourself accountable for calls that you're making. And you can't just say random stuff that might come true in 10 years and call it, like really good analysis. So do it for my material, do it for others to try to find good, sane voices in this arena, because nobody's perfect and, everyone's going to have things that they're wrong about. But I do think it's important to stop and ask yourself, why is $2 trillion in deficit year after year after year, resulting in solid GDP growth, solid wage growth, solid margin growth, and all-time highs in stocks and treasury yields like still almost where they basically were 4 years ago? Not everything computes if you had these, more extreme assumptions 4 years ago. So answering why, you end up coming out with an answer that, wow, the US is really structurally able to do, 10 times what you might think it can. That should be in your framework.
Yeah. I think that bit about reflection is certainly something we should all hold the standard to our, to each and every one of our analysis. Just real quickly before I let you go, Nik, this has been really great, really informative, I think, for the audience. I'd love to take a pivot and talk a little bit about what you think about what Michael Saylor has done, not only over the last year, but since he kind of initiated this Bitcoin Treasury strategy. I know it's not like something you're covering day to day, but just kind of like zooming out and seeing, that Michael Saylor kind of brought Bitcoin to equities and showed that there was a real demand there. We had IBIT follow on with the ETF that showed that there was a lot of pent up demand for regulated, packaged Bitcoin securities. The derivatives market has moved offshore somewhat to onshore to trading IBIT options in regulated futures here in the U.S. And now, over this past year, we saw a lot more kind of follow in Michael Saylor's footsteps with a Bitcoin Treasury strategy. But Michael Saylor kind of has found a new way to raise capital through equity markets. He started this. He calls it a digital credit model with STRC and the preferred equities that pay dividends. Is that a signal that there's a big appetite out there for Bitcoin exposure from people who maybe can't stomach the volatility? And what do you think about Bitcoin kind of having its IPO moment in this last cycle?
Yeah, so on the Bitcoin Treasury side, I think it's it was a logical step in Bitcoin adoption. And I look at Bitcoin Treasuries as simply a levered Bitcoin play. So if you're able to strip out the digital credit, the preferred dividend, STRC type of vehicles, if you're able to strip all that out and just look at the common equity as being a leveraged Bitcoin play, the cost of capital in order to leverage can be in the form of a preferred, it can be in the form of a corporate bond or another financing vehicle. And as long as the return on the asset outstrips the weighted average cost of capital, the project gets the green light and you get to buy the Bitcoin. And if it doesn't outperform, then your liability structure is going to eat you up.
I want to talk about something that comes up in almost every conversation I have with Treasury executives. They get the Bitcoin thesis, they see the macro case, but then they walk into a board meeting and the first question is, who's holding it? Are they regulated? Are they insured? Can we audit this? That's where BitGo comes in. BitGo is an OCC-regulated national trust bank. That means they operate under the same federal oversight as the institutions your board already trusts. Your assets are held in segregated trust accounts, never commingled. They're secured in 100% cold storage with multi-signature architecture. If you're building a case for Bitcoin on your balance sheet, BitGo is the custody partner that turns a board conversation from why into when. Visit bitgo.com/Bitcoin-Treasury to connect with their team.
You wished for it. Bitcoin is finally on sale. And if you're sitting on BTC and want liquidity without dumping your stack, Arch Lending can make it easy. You can get USD or USDC in minutes, and your collateral stays in qualified custody. They never rehypothecate your assets. As your assets move up and down in value, you can scale your credit line instantly or pull collateral back when the market runs. If you need help, you get real humans 24/7, not bots. This is Arch Lending. Simple tiers, public pricing. You can check them out at archlending.com.
That's basic corporate finance, and that's what they're doing. I don't think it's outside of the realm of what a normal adoption window would look like in Bitcoin heading into a much more financial sphere. This includes corporate finance type people who want to seek gearing. That's what corporate finance is all about. It's about gearing, and the equity is a claim on the assets after the liabilities. So you gear to the maximum capacity. You calculate your interest coverage ratios at every scenario and you see what you can do. This is what bankers are doing all day, every day. Private equity, investment banking, mergers and acquisitions. It's all about what's the exact right gear for this company and this cash flow. Well, Bitcoin doesn't have cash flow. It makes the gearing a little bit more complicated. It makes the target difficult to achieve. And that's what I think about Bitcoin Treasury. So quite natural. Michael Saylor, a pioneer for sure. Now, I will say that I think I don't own these. I don't own these equities. It's not my style to take that type of risk. I want to be exposed to Bitcoin, so that's my bias. And what I'll say, I think that strategy is doing a good job. I think that STRC vehicle, I make fun of it for losing par because it's all everyone could talk to me about over the last 12 months is STRC the new risk-free rate? And I said, no, dude, it is not the new risk-free rate. And so I'm having a little bit of fun with that, but it's really to just poke holes in these catchphrases that people use to describe STRC. So, but I don't think they're bad vehicles, and I think that when Bitcoin goes up, these vehicles will turn back to par, and the equity will probably do. It could do better than Bitcoin straight up. It's also done way worse than Bitcoin during the bear market, and that's what it's basically designed to do. And on the sailor side, somewhere along the path, I I find some of it odd, and what I'll say is I don't I don't find the financial engineering as odd as some of the communication methods. Like Danny Knowles is a friend of mine. That didn't I don't know if you saw, but that didn't have to happen like that. And so, I thought that was odd, and I think that there are some things that are odd. With that being said, I've interviewed Michael Saylor a few times. I have a course on his Saylor University, and we'll see how it goes. But I'm not a shareholder, so I don't have a. I think my opinion is that of a non-shareholder.
Sure,
Yeah.
sure. Yeah. It's been interesting to see some of the uh, friction, I guess, within the Bitcoin community between Michael Saylor, some more like standard Bitcoin OGs who say hold spot Bitcoin and equities are trash and everything in between, right? There's a whole slew of perspectives about what Michael Saylor's been doing, but it's been really really interesting to watch, and I really appreciate your perspective on it, Nik. Just wrapping here, just real quickly. What's the next catalyst for Bitcoin? What do you see on the horizon? Is it just going to continue to be a liquidity story, like you're covering, or is there something that can, I guess, spark Bitcoin into this next bull market?
The people of the United States, the citizenry, made a decision in November of 2024 to change the course of the world by rejecting globalism wholeheartedly once and for all. That decision is categorical, and it's now in the rearview mirror. Off the back of that decision of the American populace, you have a series of events that are playing out. What has happened since January of 2025 is a return of power politics in a major way. It's the return of American economic statecraft. That is the story. The AI revolution is the second story. Bitcoin is not a story in the last 2 years of planet Earth. I genuinely believe that. It was a major story before that, and it will have its return to the spotlight once we get past this adjustment period of American economic statecraft is now the dominant force on the world, as opposed to free market liberalism, World Trade Organization orchestrated trade, and China dumping, to put it mildly. That whole 24 years of global activity, which is the entire Bitcoin life, that's over. And so the transition out of that will bring new it will bring a new economic environment. I believe Bitcoin will win in that economic environment too, but it has to find its narrative. So your question was, what's the next catalyst? The next catalyst is Bitcoin finding its next catalyst. I don't mean it tongue in cheek, but I think it finds it outside of American economic statecraft, which is the dominant force. Bitcoin might attach itself to that, and it is in some ways. Genius Act, Strategic Bitcoin Reserve, BlackRock, even strategy, I would argue, to some extent. There's a lot going on there, but it can also latch on to something outside of the United States, such as an Asian financial crisis. So I'm watching Korea and Japan devalue their currency, to support their bond market, and then support their currency market if it gets too weak. The Korean authorities trying to come in and bail out the Korean stock market after it went into a bubble. The Indian government trying to raise euro dollars from Indian nationals outside of the country for a dollar demand because their currency is losing value because they have to spend money on oil. Again, an American economic statecraft move to move the oil price higher around the world. It's not like they didn't know this would happen with the attack in Iran. So Bitcoin will find its path back to decentralized store of value, but it has to wait because right now there is other stuff taking dominance. And I've been writing a lot about that at the Bitcoin Layer.
Great stuff, Nik. Really appreciate it. This has been a real treat. Where can people follow you at the Bitcoin Layer?
TheBitcoinLayer.com, everything we're doing. So, we have a YouTube channel, audio podcasts. People can catch us there. We have a newsletter. We have a free macro newsletter on the weekend. And then I do research during the week for our subscribers. And we have one place I would really love people to check out is research.thebitcoinlayer.com. We've merged our homepage and our data terminal, but at research.thebitcoinlayer.com, you get access to our data. And it's a standalone product also, but there's also a free version. People can check it out. See our TBL liquidity index. That's available for free to everyone. So go check it out, thebitcoinlayer.com.
Definitely do check it out. Some of the best data, some of the best analysis. Nik is a leading voice, not only in and around Bitcoin, but the broader macro space. And if you aren't already following his work, you're living under a rock. Please follow him. Your life will be better because of it. One thing I have all our guests say before they leave, Nik, is stay orange.
Stay orange.
Love it. Ladies and gentlemen, Nik Bhatia.
Thanks, Tyler.